Blowout. That's what Wall Street analysts are calling the September jobs report. At 366,000 new jobs created in the U.S. economy, then looking at an August revision of another 155,000. This is a roaring market. We saw the stock market actually had a knee-jerk reaction because everybody thought the Fed would continue to hike rates, so they sold off. Then we had a complete reversal. But our guest today actually thinks that the consumer is driving this growth in equities, and she's actually optimistic, cautiously optimistic for the fourth quarter. Welcome, everyone, to Buy, Hold, Sell. I am your trader, Todd Schoenberger, and I am joined by my friend and co-host, Tobin Smith, out in sunny and hot Scottsdale, Arizona.
Warm.
Toby, you're outside.
It's warm.
It's warm outside. It looks nice and sunny, though, I'll tell you that. And our featured guest today is Lindsey Bell. She is the chief strategist at 248 Ventures down in beautiful Charlotte, North Carolina. Welcome to the program, Lindsey.
Thanks for having me.
Absolutely. Well, we had to turn to you. We know that we had to get an optimistic feel. We had a couple of guests on this week that I would say are a little bit on the pessimistic side. We want to go into the long weekend thinking things are looking up. And so who else to turn to but Pittsburgh's finest? I know you're down in Charlotte, but you are a Pittsburgh girl. But Lindsey, what was the turnaround all about today?
Yeah, a lot of people I think there were a lot of things at play here. I think a lot of people initially pointed to the wage number, which was a little bit lighter than expected. That's a good sign, obviously, for when you're thinking about what's going to happen with inflation. It also means that maybe the Fed could potentially be done. But I think there was more to it than that. I think that this was a good jobs report, okay? This was where supply, which has been weak, is actually starting to catch up with the demand that has been really strong by corporations. So I think you're starting to see that kind of balance each other out, which is a good thing. But the other question that I have is a lot of the bears, I think, in the market right now are talking about the yield curve, the 10-year yield. We're seeing a bear steepening, as they call that, as the 10-year yield rises faster than the 2-year yield. And a lot of people are worried that that is because of the supply of treasuries coming into the market rather than strong economic growth. Those are two very different things. And I think today's jobs report really showed that the economy is strong, but maybe not too strong. Like I said, supply catching up with demand in the jobs market, and inflation, at least from a wage perspective, is remaining under control. So I think that yields backed off, and that allowed the stock market to rally into the end of the day.
Todd, I also had a couple of things. I mean, technically, it's very interesting today. So one of the things that we follow is just trade size. And trade size was saying that it was retail people who were selling, not and we had people who essentially, this was like the capitulative day where, yesterday you had big units selling, and I would call this the exhaustion type of bottom, where everybody who had to sell, who was getting a margin call, was, so on and so forth. That happened by about 11 o'clock. Yesterday, it deteriorated simply because it's simpler to say, hey, you know what? We're going to have an over 5% interest rate on the 10-year. By Rick Santelli was saying on CNBC, 13%. I just sent him a text, and I said, Rick, are you drinking again? I mean, come on, man.
Yeah, that was a wild prediction. I saw that.
I mean, and he was using like technical analysis. I said, well, that looks like a Viagra chart, Rick. That doesn't look like an actual chart. But be that as it may, he is, he's on all day. He's on in every trading room I've ever been in. And when he comes up with 13% number, but it was that exhaustion sell. Does that change any of the macro? No. What's confusing, I think, for everybody, probably not Lindsey, but everybody else, not from Pittsburgh, is that everything that used to be in the playbook is now idiosyncratic. The playbook never had any of this stuff before. The playbook never had that you're going to have quantitative tightening. Does anybody talk about that? That's $95 billion a month. But and no one's ever quantified it, and the fact that it's being sold. When 10 years went up, the market was putting the 10 years up, not the Fed. And that was a supply-demand imbalance, right? There was, too much supply coming out over the last 3 days on QT and other side. And then the other thing that came really out, Todd, was that I don't think a lot of people know, unless you work like Lindsey and I do with pension plans, actual big pension plans. Their bond portfolios on average are down 48%. That was in Bloomberg yesterday.
Yeah.
And if you're down 48%, I used to sell bonds, but I love bonds. That's how I started. But if you're down 48% in your bond portfolio in terms of valuation,
yeah,
then you've got multiple problems. I mean, you're going to hold them till, the fruition, right? You're going to hold them till they get redeemed. But now you're going to need to do something to rebuild valuation. And so that makes a case for the Magnificent Seven, which I'll end it with this. Everything that we trade, everything that we look at, everything we measure is the new life raft, which used to be utilities. That's gone. The new life raft used to be consumer staples. Gone. That's down. I love the fact that, that vitamin V is what's getting every people to eat 50% less. So therefore now, they're not snacking. And so the safest port in the storm are the 10 tech companies that have $750 billion of cash that at 4.5%, 5% are spinning off $3 to $4 billion a month for doing nothing. That's the safe trade.
Yeah, I have to agree with you. And, we do have a critical earnings period that kicks off next week. You mentioned the tech side. Tesla will start on Wednesday, the 18th with their earnings report. And then the following week, you have Apple and Microsoft. It'll be interesting to see if that is going to be the octane that pushes things forward. Lindsey, one thing that we have been, we had Jeffrey Hirsch, who is the editor-in-chief of Stock Traders Almanac, and then Sam Stovall, who is the chief market strategist over at CFRA. And both of them really have been spot on with this. They actually said August and September, we will have some downside pressure. And then And then the fourth quarter, we should see things really kick off. And actually, Jeff went out to say that we should see the higher highs by the end of December. He's actually just predicting either he said the last trading day or the second to last trading day, we'll see the highs of the year. Where's your stance, though? Because you mentioned when we were talking off camera that the consumer might be a bit stretched. You are a big fan of the consumer, as everyone knows. But do you think that going forward, the consumer is going to have enough octane, at least going into this holiday shopping season?
I do think they're going to have enough octane going into the holiday shopping season. And Sam's an old pal of mine. I used to work with Sam very closely. So,
I worked with his dad. That's how old I am. Okay.
Oh my God. I never got to meet Robert, but I've heard all the good stories. The seasonality thing is not voodoo. It's for real. There's a lot of data and history behind it. And October starts to get better, and then November, December, even better than that. And I do think that the consumer, while they are beginning to feel a little bit stretched as stimulus money starts to disappear and, student loans and other obligations come back online, I think that they are, as long as they have jobs, that is like the key for any recession, right? As long as people have jobs and they're getting paid and real wages are finally increasing. And like I said, you're starting to see more people jump back into the jobs market, I think, because of that stimulus that is waning. But you can't ignore the delinquency rates for credit cards and auto loans are increasing. If you look at household debt as a percent of income, that is still, it has come back up to pre-pandemic levels. You want to keep an eye on it to make sure it doesn't go up significantly more. Mm-hmm. Interest rates are really high. It has become more difficult to access credit. So these are all real things. But I do think the consumer, you saw in the back to school shopping season, the consumer who hasn't been purchasing goods, they've been spending all their money on services and experiences. They opened their wallets during back to school season if there was something exciting to buy. Also, they weren't hesitant to spend on their children. And I think you're going to see the same this holiday season. The only question I think for retailers is, are they going to have the exciting merchandise to sell to their consumers? Because I think so many of these retailers have been downbeat. Their businesses have been very, very weak. You look at the retail stocks, they look terrible, and almost uninvestable. But I do think that it could be a good holiday season. I think there'll be some discounts, but I don't think they'll be significant because I don't think they're going to have a lot of product. And I just think the consumer wants to feel good and wants to spend this holiday season. The beginning of the year, though, I think the consumer is going to be put to the test if economic activity, which we're seeing good green shoots in many different areas. Like I think manufacturing is turning up. The housing market seems to be turning up. We've seen rolling recoveries all over the place. Manufacturing, in fact, was a bright spot within the jobs report today. So I think there's good reason for a rally into the end of the year, in addition to fundamentally related and seasonally related.
Lindsey,
I'm optimistic, Toby. Joe Biden's going to say it's Bidenomics. Do you agree with the president?
Don't do that political shit with me, pal. All right. Now, the issue I've always been harping on over the last year has been, it's still 20% of the highest 20% of the households by income account for 76% of discretionary spending. The upper 20% is doing just fine. And now that, the stocks took a run for a couple of years, maybe they're down 10%, et cetera. So there's no unwealth effect as we had, in the past. Number two, I guarantee you, everybody I know with kids is buying their kids really great stuff. So they'll leave the freaking house, go to school, go to football practice, stay the F away from me because I'm working at home now. And that to me is just a guilt thing. And number three, we got the Taylor and Beyonce economy.
They've got movies coming out too.
They got movies coming out.
The movie theaters.
When two people move the actual GDP of some cities 14% in the greater Phoenix area here, that Taylor Swift 4 days moved the needle 8.5%. I don't know. I don't think they're even counting selling drugs, because that could have been another 4%. Okay, but the economy as consumer is strong because the top 20 or 25% are strong and they're not coming back. Everybody's done their European, vacation. All I do is get texts from friends saying, "Oh my God, I can't believe you could have 40 million people in Venice today, but we must." Because everybody, that stuff's going on. Now we're going back to sort of the spending of stuff that we didn't buy during the pandemic. And my other note, Lindsey, always is that I don't think people quite realize the United States, 96 million people in those households is at least getting one pension, one Social Security, a check. That's government, that's federal, that's corporate, et cetera. But those checks come every month. They never stopped. And I know people who cut their cost of living and, are now like 75, and they're making more money now from their pensions and their Social Security than they ever were from working.
Yeah. Well,
that's why we're resilient. It's not a magical thing. It's that there's more money going into the economy than it's going out of the economy in spending, and maybe it's evened up. But try to get a reservation tonight in Scottsdale. We're going to a pre-dinner thing. We have to be there at 3:30 to get in.
Oh, early bird. Well, that's
No, it's not even early bird. It's not that. It's happy hour. Okay, we don't do early bird out here. That's Seinfeld. That's Florida.
Very good then. So, and also, if I understand you correctly, it's not Bidenomics, it's Taylornomics. That's what's really pushing this thing.
Exactly correct.
Taylornomics it is. So listen, let's leave it there on this block, because coming up after the break, we got to ask Lindsey about some specific sectors. We want to talk about maybe some areas to stay away from, some areas to concentrate on, especially going into the new year, because we want to know if that consumer, if they are under pressure, what's actually going to look good for Wall Street. But we'll get into that after the break. And with us today, we have Lindsey Bell. She's a chief strategist over at 248 Ventures down in Charlotte, North Carolina. And we also have to talk about the Ravens-Steelers game coming up, because Lindsey is from Pittsburgh. But we'll get into all of that after the break. Please stay with us.
You really want that brain damage? Todd,
Buy, hold, sell, brought to you by Crosscheck Management.
Way too long. I got to get back in my zone. Hey. Hey. All right. Come on. 3, 2, 1. You know I'm feeling too good to be cooped up. Hey ladies, don't we look good? We came to have a good time, baby. Feeling too good to be cooped up. Me and all of my girls, we gon' tear it up.
Well, Blockbuster Jobs Report came out, and we actually saw Wall Street traders start selling, but we had things turn around. We saw a complete 180. All the major averages were up. Actually, I think the Dow was only up on I think the what
Yeah.
0.9%, I think, Toby. But overall, Nasdaq was up big, S&P 500 was up big, and we haven't seen gains like that actually since late August. So it was a nice optimistic turnaround, and we think hopefully it's a start of some good things to come for the fourth quarter. With us today on Buy, Hold, Sell, we have Lindsey Bell. She is the chief strategist over at 248 Ventures. And Lindsey, when we left off at the last block, we were talking about really a lot of the good things that are happening with the economy that probably get tossed away because the bears actually have had the run over the last 6-7 weeks or so. But what about for this earnings season? Are there any specific sectors that you have your eye on that you think might be poised for a breakout?
Yeah, so this earnings season, the third quarter, we're expected to see the fourth quarter in a row of earnings declines. The estimate right now, the consensus estimate is for a decline of 1.2%. That's from S&P. And usually it's pretty typical, analysts set the bar low and then the companies come in and beat. And it's very likely that we could see a positive earnings growth quarter. As far as sectors go, what I like to do is, because I've been looking at sector earnings for a really long time. Like I said, I worked with Sam at S&P Capital IQ, and that was kind of like my thing over there. So when I look at the sector earnings, I like to look at how the numbers have been moving since the beginning of last quarter. And, a lot of people talk about how the second half numbers have been moving higher. They've moved higher slightly, but the third quarter, we're kind of flat with where we were at the beginning of the quarter. Again, like I said, numbers went up, but they come back down the closer you get to earnings, because we like to make that bar nice and low, right? But what I've noticed is that, the sectors that are seeing estimates increase is consumer discretionary. Of course, Tesla is in that number. Of course, Amazon is in that number. They account for a big amount of that. But the sectors that I find the most interesting is the ones where the numbers are being cut substantially. And industrials is one of those sectors. And I know that the sentiment around the industrial sector right now is super negative. Obviously, higher interest rates, not good for the sector. And, the manufacturing drag and weakness in Europe and China, although Germany data this morning, the manufacturing data is finally starting to look like it's turned around. Granted, it's 1 month. I don't know if it's a trend.
One time is not a trend, but yeah.
Right, exactly. So we'll see. But we do have the policy benefits. You talked about Bidenomics. So there is money coming into what will be the manufacturing sector. You're seeing construction spending that is ticking up, and manufacturing within the construction spending number was up 65% in August. So it's coming off of really low levels. And the ISM numbers, that's another indicator of the health of the sector. They're still contraction, excuse me.
Easy for you to say, Lindsey.
Right, exactly. It's still in contraction under 50, but it's moving up, and it's been, it's 31 months off of its peak. So it's about time for this sector to start turning around. Industrial production is improving. I think there's opportunity within this sector. The numbers have been cut. The sector is underperformed since the end of July. It's down 10%. The S&P 500 is down 8%. So the valuation levels have come down. So I just think there might be an opportunity for this sector to beat the estimate. So when sentiment is dour, I don't know that the manufacturing sector is going to be completely better here in the next couple months, but I think there's
the part of the manufacturing sector that I was Capital on was impressed with was because of the IRA Act, because of the knock-on effects of 800 billion here, 800 billion there, starts to add up, and then lending wise, the ESG lenders were just going cray. Well, that money just dried up, and if for instance, if you look at SunPower, for instance, but you look at any of the solar power plays, they mostly got crushed simply because A, they changed the rules in California on their tax credits, and then B, it just became friggin' so expensive that stuff doesn't pencil out. My advisory firm, we represent a company that's raising $220 million to build carbon capture on utilities. It's an amazing thing. It's about a 50% cash flow business. And I had like $75 million of stuff lined up that did not go through to this week because they had to recalibrate what they think their cost of funds was going to be. So we have ceilings and we have floors here, and that we're sort of in this channel of economic activity. The floor is not falling out for all the obvious reasons. The ceiling is limited somewhat. The ones that have blown me away, Todd, I mean, wait a minute. Ozempic made, ketchup sales go down 8%, and Twinkies, and, Twinkie just sold for like half of what it sold for in private equity a while ago.
Yeah.
I don't know how many people are on Ozempic, but man, that's a shit ton of people that are not buying Doritos or, Coca-Cola, Heinz. And that was the most intriguing numbers I've seen. And they're getting that data they get the data 24/7. So, taking the Ozempic economy away from the normal economy and the Taylor Beyonce economy, what we're seeing is in the United States, it's a pain in the ass to travel. And because you're in the office 3 days a week, not 5, you're seeing a real downturn. And that's why you saw these downturns in these domestic airlines. And the reverse is, I have 3 people flying in today to Phoenix. We're going to stay over. And then they're flying down to Rio de Janeiro. And one's going to Africa and one's going to China. They're spending like drunk sailors, for crying out loud. So that's the bifurcation. I mean, the fancy word is the bifurcation here. And the trends, you have to really, in my mind, we have to really go through these trends and look at all the ingredients in the trends, because I do think that these changes in the huge changes in the job numbers, like 3 months in a row, that means something's effed up. I mean, you don't get that big a change. So blah blah blah. Guess what? The sector that's winning is the sector that doesn't need to borrow, has subscription revenues, not piece by piece revenues, that has extremely high margins, has an incremental sale cost of basically nothing. Gee, what does that sound like, Lindsey?
Yeah. Well, real quick though, we had Jim Bianco on Buy, Hold, Sell, and he did bring up a very good point that here you're mentioning, Toby, about people that are flying into your town and then they're going to be flying out to all these great cities, for vacations. And Jim brought that up to us where he said, look, you have this baby boomer generation that is retiring, but they're the ones that are actually going out spending money. That is holding up the economy. And we could talk about Taylornomics all we want, but I mean, and it's great that she's going to move the needle, but that's really short term. Really going forward, long term, and this goes back to reinforce what Lindsey was saying earlier with the consumer, is that you still have this consumer generated type of economy. The consumer continues to show that, hey, they do have some cash. They might not have the ability to access credit, but they are out there spending. And that's the C. It's helping on that GDP number.
Yeah, but boomers don't use credit. Boomers pay a credit card off. The issue on these auto loans is simply that, when you used to buy a Ford 150 truck, and I don't know about you back in Pittsburgh, but when I bought the first one, it was $22,000. That same truck is $67,000. And, and the interest rates are at 7%, or excuse me, I mean, for decent credit, 9%, for okay credit, 12%. I didn't understand it. Did they not read the paper? The people who underwrite those loans, didn't they see that interest rates were coming up and they priced based on the 10-year and blah, blah, blah. So we have pockets of stupidity that, are falling apart. But economies do. I would just go back and say the same thing, that with 96 million getting a monthly check, with 15,000 boomers turning 65 or 70 every day till 2032. And we have the job, unless we go to Venezuela and capture 3.5 million people and bring them in the United States, we're going to have an upside down demand versus supply that keeps people working. That's reality. And what the bear case has always been, but you got to add up all these little incremental problems, and once you add them all up, it suffocates the economy. And yet, it's not, and the reason it's not is because everybody's working who can work, and we have 14 million people here in the United States. I just saw somebody today that send money home to Venezuela, to Mexico, to China, to etc. Those people depend on those people working. So it's still the strongest economy in the world for a reason. It's 74% consumer. So we're not like a manufacturing economy.
Right.
And you can't have a recession unless the Fed actually has the stones to take the rates to Santelli land. Because then you would get incremental, job firings, et cetera. But we have 2.5, 3 million jobs extra every freaking month. And, every place I go, there's a sign, particularly a restaurant, hiring. The car wash I was at a couple days ago. So,
Right.
come on, man.
Right.
And,
Well, Jamie Dimon did say about that. He said, look, maybe the banks should be ready for a 7% 10-year yield. I mean, you have to get to 7 before you get to 13%, back to the Rick Santelli thing. So, Lindsey, so on that, we had, and what Toby was talking about with the boomers that are traveling, we saw the leisure and hospitality sector they increased 96,000 jobs last month. I mean, clearly this is an area with the airlines, with the hotels, cruise ships. Is that an area that you have your eye on as far as maybe the airlines, they're poised for a breakout?
The airlines are difficult because they're such a trading mechanism, right? And I think there was an analyst today that downgraded the whole sector, I think. But I don't think travel is going to slow. I'm with Tobin on that. Anytime I'm at the airport, the thing is packed. Here in Charlotte, they're just like many airports, they're completely redoing them. So, I think that the demand for the airlines is still there. I think oil prices that have been up over the last quarter is a struggle for them, right? But prices are coming back down, which helps the consumer. So I think there's some give and takes in that sector overall. But I do think within the industrials, you just kind of have to look around for the sectors that are going to.
Okay, Lindsey, how about some names? Do you know names?
I don't have any specific names. I'm not a stock picker these days. Sorry.
Okay.
Yeah, if you would have told me to come prepared with names, I would have done that.
All right. Next time
I will do that.
So are there any sectors that you would stay away from, though?
Sectors that I would stay away from going into earnings season?
Yeah.
I think the energy sector has had a big run going into the earnings season. Obviously, higher oil prices benefits those stocks very well. The oil price is very highly correlated to earnings, and we've actually seen earnings estimates move up, even though they're supposed to be negative for the quarter. So the valuations there have gotten a lot richer. So I think that there's just high expectations baked into the sector. So that's one sector that I'd probably avoid going into earnings season. The other sector, though, that I'm a little bit curious to see, I don't know that I would jump into it before earnings, but I'm interested to watch to see how it performs, is the financial services sector. Because they haven't quite caught up to the beginning of the year before the banking crisis had occurred. And what we have seen though is that the IPO market is seemingly back open despite the downward trend in the S&P 500. That's kind of curious. But investment banking is back up, and I think they have other offsets to the business. So I think that's going to be a curious one to watch and to also listen to, because interest rates being this high definitely has certain impacts on their business, and it depends on obviously if you're asset heavy or light and things like that. But it's going to
I'm not big on the financial here simply because if you take the cost of funds and then you look at their book of business, they're doing, the guys who can still, Charles Schwab and TD Ameritrade merge in a couple of weeks. And TD Ameritrade was paying like 25 basis points on your cash. And Schwab, has their SWFFF that pays 5.25. Well, there's, the brokerages people are not stupid now, and they're taking their money out of their cash account if they haven't, and they're putting it into, a mutual fund where they make zero money. You got CDs here that are selling now at 7.5%. And if you're selling a CD for 7.5%, but your average book of loans is paying 6.5%, you don't have to be a smart man to know that that's not really good. So I'd be very picky in there. And then Goldman Sachs is a total dumpster fire for a variety of reasons. And Jamie just likes to sort of just pour hot water on them all the time. But their earnings, they did some IPOs. They're all underwater. They're at least 20% down from where they want. And, that's a flash in the pan that offsets against firing costs, blah, blah, blah. So I don't know, man. Here's where we're making a lot of money. Uranium processors, tankers, LPG tankers. The Panama Canal is water so low that there's now 75 tankers sitting on both sides not delivering. So now you got to go around, the Cape of Good Horn. You got to go to the Suez Canal to get propane, particularly propane. And we're making money in the AI beneficiaries that we didn't chase, but we bought them, when they came back to the world. And we're up. I think our total portfolio is up 35% this year by being very, not sector, mini sector focused. And that's where I have found opportunity, Todd. But it's the macro. I could give you 5 reasons why it sucks, and I give you 5 reasons why it doesn't suck. You put them all together. It's like in a lock. It's like a hammer lock, right? But when my LPG tanker rates went from $28,000 a day to $56,000 a day, and then they get leased out for 2 years, and I'm getting 25%, 28% dividends. What do I give a crap about what Jamie Dimon says?
Right.
And dividends in a shitty market, that's a technical term, Lindsey. In a go nowhere market, what makes a difference, I've done this for a long time, is dividends. And so we're getting huge dividends out of these bulk shippers, LPG shippers, and I'm talking about 38% dividends, because the old days in shipping was the guy's name was Greek, Namolopoulos, and as soon as he started making money, he went out and bought a whole bunch of more boats. So when he went to the Greek club in Cyprus, he could say, "Look, me, I have five new boats," right? So they would just buy more boats, and then they'll sink the whole freaking ship, pardon the pun. Then the whole sinking ship would go to shit. And then they'd give those boats back, or they'd sell them for scrap. And the circle was just like this. It ain't that way anymore. The kids took over the businesses. They've seen their dads, go crazy. Dad's on third wife anyway, so he didn't like them very much. And they are making money, and they distribute 85% of their cash flow. Now, that's a good place to hide, in my opinion, Mr. Schoenberger.
That's amazing. That's amazing. All right. Well, that's great. Lindsey, any final words before we close out the show as we do go into earnings season?
Go Steelers. Oh, sorry.
Go Steelers. And I think it's going to be a better earnings season than people expect.
Okay, I like that. This is some great final words. Well, all right. Well, we do have a big matchup in the Ravens. What's that thumbnail? So we put that up. That's right. You got that right. And we do have the Ravens and the Steelers. Lindsey's Steelers. My Ravens are playing this Sunday, and my Baltimore Orioles are facing the Texas Rangers in the first game of the next round of the playoffs. So it's a lot of optimism to go out there. So we got a lot to look forward to. All right, guys. So listen, on behalf of Lindsey Bell, Lindsey, thank you so much for joining us today on Buy, Hold, Sell. Can't thank you enough. Really like to have you back, and especially as we get past earnings season and see if the forecast actually holds up, and we'll go from there. Then that's great. So on behalf of Lindsey Bell at 248 Ventures and Tobin Smith, I am Todd Schoenberger. Thank you once again for joining us on Buy, Hold, Sell. Take care.
Buy, Hold, Sell, brought to you by Crosscheck Management.